Hello everybody, we're going to go third time lucky now for this afternoon's In Conversation With. I'm just going to get Sam up and running. I've had to move locations, so I'm now outside sunny Somerset House, but not usually hanging around here, but the signal inside is so terrible. You've got to do what you've got to do. Right, so let's get Sam back in. There we go. Hopefully this will work this time. Hello! Okay, welcome to London. There we go. It's a bit of a different background there, and I guess we've got to start all over again. We just had an amazing session, and obviously the internet hates us. So, hello Sam, thank you so much for being here this afternoon. And for everybody, I'm Lottie, founder of the Jury Society. Excited to be hosting the next in our In Conversation series. Excited to be here with Sam Hart. She's a self-confessed tax geek and a head of private client tax at Claritas Tax. And we're going to explore the tax life cycle that individuals face in the UK. And again, not to say, we're not providing financial or legal or tax advice in this session, and this is all educational purely. So, without any further ado, Sam, please will you tell us a little bit more about yourself and your background, again, for the third time.
Thanks, Lottie. As Lottie said, I am a self-confessed tax geek. I've worked in tax for over 20 years. I never actually wanted to get into tax. It was one of those, as all the best things are, it was a happy accident. Ended up in tax and quite good at it, hopefully. I'm a chartered tax advisor and a chartered accountant, and I'm also qualified in trusts and estates. And randomly, I also decided a few years ago to do a doctorate in tax. So hence the tax doctor moniker. I have a PhD in taxation.
That's amazing, and I'm sure you're one of very few who have gone the extra mile to actually get that PhD in tax. So extra kudos to you. So tell us a little bit about your day-to-day work. How do you help your clients? And who are they?
Currently, I'm head of private client tax at Claritas Tax, which is an independent firm with offices in Birmingham, Manchester and London. And because I deal in private client tax, that basically means I deal with people rather than corporations or businesses. And so I'm looking to help just people with their tax needs. Often these are wealthier individuals who have significant income levels, or they've got significant wealth. And of course, one often leads to the other. Also, wealth tends to accumulate over time. So clients are often over 40, so when they've reached that point where they're satisfied with where they've got to and they're secure, and they're starting to look at trying to preserve wealth for future generations and things like that. But it can be anything. It can be just helping people with their normal day-to-day tax needs, or sometimes there's unusual things that have happened. Maybe somebody's died, maybe they've received a lot of money, maybe they're leaving the country. There are lots of ways in which personal tax advice can be needed, and I'm just there to help.
Oh, that's fantastic. And what better person, I think, with your energy and your enthusiasm about the subject as well. What can usually be quite dry, you actually bring to life, and you make it very practical and easily digestible. So this is why I have you here, to help people navigate this. So today we're going to be focusing on individual tax, as we mentioned, and so that tends to be income tax, CGT, capital gains tax, and inheritance tax. So I think it's probably most productive if we start off with income. So I don't know, Sam, if you can kind of explain the landscape of income tax at the UK at the moment.
Of course. Everybody in the UK who's a UK resident generally is going to be liable to UK income tax on their worldwide income. There are obviously nuances to all of that, but generally if you're resident in the UK, you're going to be paying UK income tax on your income. Income can be earnings like from a job, but it could also be income from investment income or rental income or something like that. Normally, individuals who are resident in the UK also get a personal allowance, and that does include children, incidentally. So if children have income in their own right, they also get a personal allowance. And the personal allowance at the moment is just over £12,500, which means you can have income of up to that amount and you won't pay any tax, which is obviously good news for those on low incomes, because they know that the money that they get, they're going to be able to keep.
That's a really good point.
Above that, if you earn higher levels than that, broadly up to it's a little over 50,000 if you add the personal allowance and the basic rate band of tax. Up to that point, you'll pay 20% tax on the excess over your personal allowance. Over 50,000 ish, you're going to be paying 40% income tax, and if your income is over 150,000, then you're paying 45% tax.
Which is quite significant.
It is. There are 2 points to note. One is that once your income starts going over 100,000, your personal allowance is withdrawn at a rate of £1 for every two, which actually means during that band between approximately 100 and 125,000, you're actually paying an effective tax rate of 60%. So in certain circumstances, you can do things to try and stop falling into that bracket. There are other situations where that applies, particularly around child benefit withdrawal, which is between 50 and 60,000.
Yeah, and I think that's that's the sort of the trigger point. Anybody who gets over that £100,000 income tax rate, they should be thinking, right, I need to go and get my affairs looked at just so that I can be as efficient as possible and be, helped to maximise the income that I could receive.
Yes, I mean, there are a couple of ways you can do it. One is by making pension contributions, and another way is if you have any control over the level of your income to try and adjust it from year to year to make sure you're only hitting that 100,000 every other year at the most. But the other point to note, again, very topical, is that if you do have earned income as opposed to investment income, then as just announced last week by Boris, you're now going to be paying an additional 1.25% on your earnings. From April 2022, that's going to be an increased national insurance contribution, but from April 2023 onwards, that's a standalone tax. And that increase applies to national insurance or to earnings by both the employed and the self-employed, but also to employers. So the cost of an employer employing somebody is also going up by that amount.
Yeah, and we touched on this before in our previous recording of this, which is now in the ether, about how actually this is quite a political tax, and there's a lot of uproar from individuals thinking and saying that this is a tax on the poor, because it's not going to be affecting those who have already accumulated wealth, but it's for them, the ones who are at the lower end of the earning spectrum, who are going to be hit hardest by this. And I don't know what your thoughts are on perhaps, what you see as a professional advisor on this, what the industry is sort of thinking about that.
I mean, to a certain extent, as tax practitioners, we just deal within the rules. But on a political level, it is an unusual move and not one that we would have foreseen coming. There's been lots of talk about changes or possible changes to capital taxes, which we can perhaps touch on in a minute. It was always suggested that he wouldn't be able to increase income tax because so many people's incomes have been so adversely impacted by the pandemic that it wasn't felt that the public would accept additional income tax. What he's actually done is possibly worse than increasing income tax, is because he hasn't increased income tax, but he's put a new tax on income, but it's only income on workers. So people who are retired, people who have income from property, people who have investment income, they won't be affected by this increased tax. It's only going to be people who are still working. From April 22, it won't affect anybody over state pensionable age because they're not liable for national insurance contributions. But from 2023 onwards, if you are continuing to work past state pension age, you will actually be caught by this additional tax. But again, it's just on workers. And the reason that it is described as a poor tax is because it's going to disproportionately affect those on lower incomes and those on higher incomes. So those workers, people like NHS workers, care home workers, who've been, saving the country during the pandemic, are now going to be hit hardest by this new tax. And to try and explain it, it's a regressive tax because it's a flat rate. And what that means is, if you have less money to start with, you're going to feel that pinch a bit more. So if somebody has £100 worth of income and they're paying an extra £1.25, that's not very much. But if you raise the amount, while the amount goes up, so it might go up from £1.25 to £12.50 or £125. But if you've got £1,000, £10,000 of additional income, you're not going to feel the pinch in that same way.
Yeah, it's not relative to earnings at all. And actually, I think it might be quite useful to give a insight into actually what is national insurance tax. You know, where is it going to? Because I think some people kind of are like, well, what is it? And also, you know, how you have to get the cumulative years in order to receive state pension. I don't know if you can just touch on that a little bit.
Yes, I mean, national insurance is. Politicians are very good at using different words. National insurance is not a tax, it's a levy. And I think this new tax will also be called a levy rather than a tax, just because it's political. And national insurance was introduced originally at the same time that the state pension and the NHS were introduced as a means of funding those, you know, very costly programs. The problem with the state pension is we've got more and more people surviving to state pension age, living longer, so the bill for providing the state pension has just got bigger and bigger, and it's trying to fund it. Many people feel that the money that they pay in national insurance goes directly towards those things. It doesn't actually. It all just goes into a pot at the Treasury. You know, Boris has said that this new tax will be hypothecated, so ring-fenced purely for the national insurance and social care, but whether that actually happens in practice, we don't know. In terms of what your national insurance contributions get you, provided you've made the minimum number of contributions in a year and a minimum level of contributions in a year, that effectively gives you, and it's called a stamp because it used to be an actual physical stamp in a book. It isn't that anymore, obviously, it's just a digital record. But provided you have sufficient stamps, then you will qualify for a full state pension when you get to state pension age. The amount of the state pension is fixed, although another manifesto promise that has gone by the wayside is the triple lock on state pensions, which was that it would always increase annually by the highest of 3 figures. Now they've just decided to increase it by what they feel is appropriate, and presumably what they can afford. But yeah, so if you don't pay national insurance, then you don't get your stamp. Now, for most employees, provided you're earning sufficient, which isn't a very high lowest level for a national insurance to get your stamp, that will happen automatically. If you're self-employed, you need to have profits for over a certain amount and pay your specific national insurance contributions in order to get the stamp for that year.
Interesting.
There is another way to get a stamp for national insurance, actually, and that's if you have children. If you're in receipt of child benefit, you automatically get a stamp up to the age your youngest child is 12.
I wasn't aware of that one, but yeah, I think we'll send some links across as well with all of these information, and you know, if anybody wants to chat to Sam about this, I think it's really important to get proper advice from a professional on these topics. But so we've covered personal allowance, national insurance, earnings as a sort of employed individual, but actually you can get income from investment side as well. So I don't know if you want to go over about, you know, how that works in difference to employed earnings.
Well, the increase to national insurance won't affect the people who have other forms of income, and in no case will it affect pensioners who are receiving pension income, because that's not earned income, or people who are receiving rental income, although you could argue that landlords have been targeted in various other tax moves over the last few years, so perhaps it's fair that they get a bit of a break this time. It doesn't apply to those receiving investment income, but they are also increasing the rate of dividend taxation. So if you're receiving dividends from a company, that is also going to go up by the 1.25%. Now, currently dividends are taxed at a lower rate from income tax purposes than other forms of income. So the basic rate of income tax is 20%. Dividends in that band are only taxed currently at 7.5%. In the 40% band, it's 32.5%, and in the 45% band, it's 38.1%. And that's to take account of the fact that dividends are paid out of corporate earnings that have suffered corporation tax. So with this 1.25, those rates are all going to go up by a 1.25%. They're still not going to be as high as the other income tax rates, but it will be another increase.
Wasn't there a talk as well about aligning capital gains tax with income tax rates, that possibly introducing at some point, or at least trying to scare people with this prospect?
It's funny, this has been reported many times, and most of it has come out of the back of an Office of Tax Simplification report, which mentioned that as a possible option. That report also said that in order to take account of inflation, there would need to be some measure to do that. I mean, in simple terms, we're slipping over into capital now. If you receive dividends or interest payments on funds from investments, that's income and that's taxed to income tax. But if you buy some shares and you sell them 10 years later and you've made a profit between what you bought them for and what you sold them for, then that difference is going to be charged to capital gains tax. Now, you do have another annual exempt amount for capital gains tax, which is a similar level to the personal tax allowance, a little bit less. So it's only gains over that amount that will be taxed. But the rates of capital gains tax are 10% and 20%. 10% if, when added to your income, you would be a basic rate taxpayer, and 20% thereafter. And there has been some talk of trying to align that 10% and 20% rate to the income tax rates. As I said, there would need to be some allowance for inflation, because if I bought something today and wanted to buy that exact same thing in 10 years' time, it would cost me more. So if I sold it for that higher amount in 10 years' time, I actually haven't made anything, because if I wanted to buy it again immediately, it would still cost me the same amount of money. So there's that element that needs to be brought in. But in a way, the reasoning behind that is to try and give more equity between different sources of funds for people, because you know, to give you the counter argument, is it fair that if you're just receiving income, you're taxed at 40%, but if you have enough money to invest it and make a profit, then you're only taxed on that at 20%? That's the question. Capital gains tax has been highlighted over the past 18 months as being highly likely to be in receipt of a change to pay for coronavirus. The problem that we have, and this is something that Boris mentioned when he announced the health and social care tax, is that capital gains tax receipts are actually quite small compared with the likes of income tax and VAT, and even corporation tax is a lot smaller. But you'd need to increase capital gains tax significantly to be able to make a dent in the
and then that becomes a political move as well, because they won't want to be scaring off a lot of sort of investors who are you know, shielding their capital here in the UK. They're not going to want to do that. So, you know, if they even put something out, a lot of money will then outflow back into Europe or, you know, anywhere else around the world, which has got a more beneficial tax, treatment.
Yeah, it is a fine line, and we've had this argument around non-doms for many years, that people who are non-domiciled in the UK, and that's a complicated concept I'm not going to go into it in any great detail.
Separately.
But there are tax advantages of being non-UK domiciled, which allows people like Russian oligarchs to do certain things that people whose spiritual home in the UK can't do. But the problem is, because these individuals are so globally mobile, if you start taxing them heavily, then they'll just go somewhere else. And the same applies. Yeah, the same applies with corporation tax, and, you know, applying capital gains tax to business owners. If you make the tax rates too punitive, people will go elsewhere, and then you'll end up with less than you had before.
Yeah, it's a total game of chess. It's you know, how can you protect what you've got without, you know, scaring people off, but then, you know, making it attractive enough that people won't get too upset elsewhere. Yeah, I mean, I wouldn't want to have the job of Chancellor, but so moving on from that as well, I think that it's quite useful to talk about inheritance tax, because so as part of the life cycle as well. So when we were touching on pensions, and as we mentioned before in our previous version, how pensions have become a vehicle for IHT, what would you call that? Intergenerational
Protection.
planning. Yeah. And certain individuals are able to sort of stockpile into that. It's held in a tax efficient manner, and then you can pass it on. Do you want to sort of develop that a little bit and explain a little bit more about the different formats of inheritance tax and some of the pros and some of the cons, perhaps, and how it works?
Yeah, I mean, if you take, going back to our life cycle idea, you've an individual who's earning, a relatively good amount of money. They don't need to spend all of that money, so they might invest it. And either invest it in stocks and shares, and over time those stocks and shares might increase in value, and you might sell them. And with that profit, you might then choose to buy a holiday home in Cornwall. So you've started with income that's been taxed to income tax. If you've made a profit and sold it, you've then paid capital gains tax on that profit. And then if you've invested it in that holiday home and you die holding that holiday home, then that holiday home is going to be subject to inheritance tax. Inheritance tax is at 40% to the extent it exceeds any nil rate band and residence nil rate band that might be available. But it is important to note that residence nil rate band is only available if your whole estate is worth less than £2 million. And to the extent it starts exceeding that, it gets tapered away until there's nothing left. You can transfer both your nil rate band and your residence nil rate band to a spouse on first death, which means that for a couple, they can leave assets up to £1 million free of inheritance tax, assuming the total estate isn't worth over 2 or 2.7 if we're doing the taper. So clearly, the more wealth that you have, the more important it is to try and protect that from a massive 40% tax hit. As you pointed out, Lottie, since they made the pension changes a few years ago, sums held in pensions, provided they remain in a pension fund and are bequeathed to your beneficiaries as a pension, pass outside of the inheritance tax estate, so they don't get that 40% hit, which is very, very valuable. And with the power of compound growth, you can be in a position where you're attempting to double your wealth over a period of time, but then when you die, you pay 40% of it in inheritance tax. So you're almost back to where you started from. So the trick, and this is an oft quoted thing, is an ex chancellor of the Exchequer, Roy Jenkins, said that inheritance tax is only paid by people who dislike their relatives more than they distrust the inland revenue. Because in simple terms, if you give everything away more than 7 years before you die, you won't pay inheritance tax. It's a little bit glib because, of course, A, nobody knows what the magic date 7 years before they die is.
No.
And
crystal ball.
B, you don't know how much of your wealth you're going to need in that period of time. And particularly, we often see people holding on to larger amounts of wealth because they're worried about care costs. Now, we didn't mention that the flip side of this health and social care cost is that the amount you'll have to contribute to care is also capped at 86,000, but that's going to be for council funded care, not for the kind of care that you might want for yourself. So a lot of people will hold funds back for that purpose. And of course, the final thing is you can't give away the home that you live in because you live in it. There's anti-avoidance rules. There have been so many schemes in the past trying to get around it, but basically if you're still using the asset, you haven't given it away. So
otherwise it's a gift with reservation.
Exactly. So even just on the value of your home, many people are going to be caught. I mean, the nil rate band is currently 325,000, and it's been that level since 2009, and it's been frozen until 2026. And even if you look at London, I think, for example, on the house price increase, that should be 650,000 just as a starting point. So actually, while he's not increasing inheritance tax by not allowing the rates to keep pace with the world, it's actually increasing every year.
Well, exactly. And I've also heard, following your quote as well, that IHT is an optional tax. So if you are well enough planned, if you have somebody like you in the wings, you can structure your assets and your legacy in order to make it as efficient as possible. And if you're talking about philanthropic endeavours as well, you give 10%, is it 10% of your estate, and it reduces it to 36%. But again, how are you going to know that? And then you've got all of the tapering. There's tapering everywhere. And I think tapering is what confused most people about all of this, because it's like, well, how much? What is the final balance? And when am I going to get it? And nobody knows, really. Apart from you.
But it is also important to note that, yes, of course, you can plan things and you can pass things to your children or grandchildren and do various other things to try and mitigate that balance. But also, at the end of the day, you need to live your life the way you want to live it. So if you need all of that money and you end up paying some tax on it, that's better than than sitting in an attic and
Scrooging.
giving all your money to your children.
Being like, oh no, that's not exciting. So I guess I'm not sure how we're doing for time here, because I've just no idea what's going on for time anymore. So we've covered earnings, we've covered investments, we've covered pensions, we've covered IHT. Is there anything else that we've missed?
I mean, no. I mean, there are some things to do with inheritance tax that we could talk about. Things like the family investment companies, which I think you actually mentioned last time rather than this time, or about trusts. But again, those are kind of more in-depth topics in and of themselves. But it's just knowing that there are things you can do in terms of tax planning, but you need to do them first. You can't. In most cases, you can't do tax planning after the event. So, and the sooner you can look at things, the better. In most cases, I mean, inheritance tax is a strange one, because obviously, if you do inheritance tax planning when you're younger, your circumstances might change. So, perhaps you'll look at more flexible options in the start, and then perhaps look at doing things like trusts, where you give away those assets entirely and you can't touch them again, when you're a little bit older and you're a bit clearer on your objectives and what you're going to need to fund those.
Well, maybe we need to do another session on that. When I've got better signal. And I'll pick another landmark in London. We can go tour around London with different landmarks. Right, so I think that was really, really helpful, and I don't want to exhaust you too much for having to go through this the third time round. But what would your 3 top tips be? So let's go for an employed individual, sort of getting your ducks in a row in terms of taxes, and then I don't know if you want to pick something for employed person, something for a business owner, and then something for sort of family. I don't know, or whatever you want.
For an employed person, tax planning is more difficult because you have less control over the income that you've got and coming out. A bit like what I was saying earlier, perhaps if we're at that £100,000 mark, look at making pension contributions, because that will reduce your income down, and effectively you won't be paying that 60% rate. There are circumstances where you can give part of your personal allowance to spouses if that's beneficial. And maybe look at structuring your package from your employer, maybe receive salary as pension contributions rather than as salary, or have bonuses every 2 years rather than every year, if that's just going to tip you over. Things like that the parameters are more narrow with employment, but there are still things we can do.
That's really interesting. Yeah. Okay, cool. Thank you. And then what about for sort of investments or anything like that, for the capital gains? I don't know if this...
Again, capital gains is more, it depends. Business owners, we had a rush of people looking to sell a business if they were in that kind of space before the last budget date, because of a fear of tax rates increasing. They didn't increase in March. I don't think that means that that's off the table. So I'm expecting us to see another influx of that now, although he announced the budget with a very short space of time, so there's not an awful lot of time for people to do that if they weren't in the position previously. But if you do have other assets that you're thinking of disposing of, you may want to do so before budget date on the 27th of October. Or, it may be absolutely nothing and we don't know. It's unusual for a capital gains tax rate to change mid-tax year. It has been done, but it's only been done once before and it was a nightmare. It's more likely to happen at the end of the tax year on the 5th of April. But just think about, it's unlikely that capital gains tax rates are going to go down.
Interesting. Well, thank you. There we go. Straight from the horse's mouth. So thank you, Sam. Where can we find you if anybody's got any questions for you?
Well, as I say, I work for Claritas Tax, which their website is claritastax.co.uk. I'm also here on Instagram as I don't even know what my username is. the tax doctor. But yes, if you just Google Sam Hart Tax, you'll find me.
And I will share your details. And thank you so much. I mean, I think this is the most fun conversation I've ever had about tax. And
excellent.
not very, although I am sat on the most awfully uncomfortable chair, so that's why I keep moving around. So sorry about that. But no, thank you so much, Sam. And if there's anything anybody needs to follow up on, I will share where to find you. So really appreciate you being here.
And thank you for asking me.
Thank you. All right. We'll see you soon.
Thanks, Lottie. Bye.
Oh, how do I do this? I don't, this is where I delete it now. No.
Don't you dare.
Okay, I know. I'm scared to. Do I press the close button? Okay, bye.
Bye.